Hello, good morning everyone. Welcome back from spring break. Hope you had a great time. Now let's get back into some macroeconomics. It's been a while, so I probably need to remind you where we were. And where we were was in the part of the course where we discuss the origins of the business cycle. And we are going to do that by discussing the theory of aggregate demand and aggregate supply. Before the break, we spent a lot of time discussing aggregate supply, and we had turned our attention to discussing aggregate demand. The way we were doing this was by breaking aggregate demand into different pieces: consumption, investment, government spending, and exports minus imports, collectively referred to as net exports. And we had discussed at length consumption. We discussed the different things that determine consumption, and we'd use that to do two things. One was to determine the shape of the aggregate demand curve in this space. In other words, we discussed how it is that consumption depends on the price level, and because a higher price level means that the real value of your wealth and income is less, we would expect the aggregate demand curve to slope down. In addition to discussing the shape of the aggregate demand curve, we also used the discussion of consumption to come up with a variety of factors that might shift the aggregate demand curve one way or the other. So you should have that list somewhere in your notes. Next, we started talking about investment. And that's what we're going to pick up today, with a refresher of what we discussed about investment last Wednesday, or rather the Wednesday before spring break. And then we're going to build on that to, again, think about what might be the shape of the aggregate demand curve and come up with a list of factors that might shift it. And today, the list is going to get quite a bit longer. So the crux of our discussion about investment was the following: that if you are considering an investment project, on the one hand, you have to think about, well, how profitable is this investment project going to be? But on the other hand, you have to think about, well, this investment project needs to be financed somehow. I need to get the funds in order to pursue this investment project. They have to come from somewhere. And there are two possibilities. One possibility is that I have the funds necessary for this investment project. In that case, what's my trade-off? It's going to be, on the one hand, I'm just going to write benefits to make it really broad. There's some benefit or profitability that I might get from investing in this project, and I have to trade that off against what? Against what I could have done with the funds instead. And if I'm deciding to pursue a particular investment project, it means that I am deciding not to do something else with those funds. And the alternative that I could have pursued instead is that I could have given those funds to somebody else, either directly by buying their bonds or buying their shares, for example, or indirectly by putting them in a bank. And either way, that means that to pursue a particular investment project, I have to compare the expected benefit of that project to what I could have earned elsewhere, which, thinking about this in terms of each dollar that I'm choosing to devote to investment or to lending, is the interest rate. The second case is that I don't have the necessary funds. And in that case, I actually could still pursue this investment project, except that I would need to find someone who's willing to give me the funds. And of course, if they're giving me funds now, then I have to pay them back later with interest. So, once again, I am trading off the expected benefit from the investment against the interest that I have to pay on the borrowed funds. In other words, the price level doesn't really come into the picture, except in as much as it might affect either of these two things. The most important thing that this is telling us is that the quantity of investment that we actually observe is going to be very closely tied to these two things. One is whatever it is that determines the expected profitability of different investment projects, but most importantly, perhaps, it's going to be the quantity of investment is going to be determined by interest rates. And of course, the interest rate is the price of a dollar that was borrowed, or the reward to a dollar that was lent. In other words, the quantity of investment is going to be determined by what's happening in financial markets. So in order to understand investment, we need to take a page from our discussion of money and banking, I guess, and think about all the different things that come into play in determining interest rates in financial markets more broadly. So to do that, macroeconomists have, well, what we're going to do is try and use our usual supply-demand intuition to try and think about financial markets as a whole. So all the borrowing, all the lending in one picture, and we're going to use that to try and tease out things that affect the quantity of investment. And this is partly a review of what we did last Wednesday. We're going to add a few elements to that discussion. So here, we're going to represent the entirety of financial markets in one graph. What is the thing that's being traded here, first of all? Well, the correct term to describe what it is that's being traded here comes from the following notion. In this case, where investment is being financed out of other people's funds, then someone is actually lending to the investor. Right? In this case, the investor is using their own funds, but they could have lent them to someone else. So the term for the funds that are fueling investment is going to be loanable funds. So that includes funds that were lent and funds that could have been lent. In this case, they were lent. In this case, they could have been. What is the price concept here? Well, if you bring loanable funds or if you borrow funds, what do you get? Or what do you have to pay? It is this interest rate. Now, as always, once we've figured out what we have on the axes, the next task is to figure out who's in the demand, who's in the supply, and what do the curves look like, and what factors move them. So the way I discussed it on Wednesday was I said that the demand for loanable funds, well, it's these people who are choosing to invest, right? If they're investing and they don't have the funds and they're literally borrowing. If they're investing and they have the funds, well, it's their own funds, but they still demanding loanable funds, regardless of who they belong to in the first place. So the loanable funds, as I described last week, are demanded by the investors. Now, of course, there are other people borrowing as well, right? There are you and me, we might be borrowing with credit cards to just finance our consumption right now, for example. So the investors aren't the only people on the demand for loanable funds, but it's important to remember that they are a big chunk of it, all right? So that's the first thing. Second thing, what shape would the demand for loanable funds have? Well, two approaches to this. One, whatever benefit you expected to get out of borrowing, if you raise the interest rates, well, you're raising the cost of doing a thing. Intuitively, when you raise the cost of doing a thing, it discourages the thing. So we have a higher interest rate, we demand fewer loanable funds, so we get a downward sloping curve. The way I described it last week, I was saying this is the demand for investment. More broadly, this is the demand for loanable funds, a big chunk of which is the demand for investment. An alternative way of getting this downward slope, which again is more closely related to investment, is imagine that you have all the investment projects here that you could pursue, and imagine ordering them from left to right with the most profitable projects over here and the less profitable projects going off to the right. Imagine on this axis we had some measure of their expected benefits. So it's a tall tower over here, we're getting lower and lower and lower and lower out here. And now slap the interest rate onto this. Any project with profitability up here, above the interest rate, is good to go. Any project below here isn't worth it. What happens if I raise the interest rates? I'm ruling out some projects here that are no longer profitable, so investment demand goes down. If I lower interest rates, I'm making some of these projects actually worth pursuing after all. So you get more investment. So that's an additional way of getting this downward sloping curve, focusing on the investment component. All right, so we have the shape. Next, where are those funds coming from? We know who's in the demand. Who is supplying these funds? Well, the hint comes from here. If I have the funds and I'm deciding to spend them on some investment project, what am I choosing not to do with those funds? I'm not using them to eat anything. Right. And if this project weren't useful and instead I lent the funds to someone else, again, those are funds that I'm setting aside for the future instead of using them right now. And funds that we set aside for the future instead of using them right now are called savings. So the supply of loanable funds is coming ultimately from people's savings. What's the shape of that curve? In other words, how should savings depend on The interest rate? Well, the interest rate is the reward to savings. So if you increase the reward to something, you'd expect to see more of that thing. In this case, we're saying if you increase the interest rate, that means that it's encouraging people to save instead of consuming, because saving is more rewarded. So what that's telling us is that we should expect the supply of loanable funds to increase with savings. I'm going to just label this savings supply to remind us of what it is that's ultimately behind there. So the point of all of this is to say that there's some factors that affect investment that just depend on, well, whatever it is that impacts the expected benefit of pursuing investment projects. But on the other hand, because the interest rate matters, any factor that affects what's going on in financial markets is also going to affect investments. In particular, we're going to assert that the interest rate is determined in equilibrium by what's going on in financial markets, and that involves both the demand, which includes investment, and the supply, which doesn't. So there are going to be a lot of factors that maybe have nothing to do with how profitable investment might or might not be, that nonetheless end up impacting the quantity of investment. If it's something that impacts the quantity of investment, it means it's something that shifts this curve. Okay? Any questions, comments, thoughts? In that case, our next task will be to create that list of factors. To do that, I'm going to need this space back. So, what affects investment? Well, I guess we can start with the obvious. One thing that affects investment is the interest rate. Of course, the whole point of this discussion is that the interest rate doesn't just come out of nowhere. Next, we're going to think about what are the things that might affect investment through the equilibrium interest rate. Now, again, the obvious thing that might affect investment is, well, what if something happens that impacts the expected profitability of investment projects in general? And you'll remember that when we talked about the production function, we had this technology parameter in the front that affects how much you get out of the use of different resources. And one broad word for that, for how effective it is that, how effective the economy is in transforming resources into output, is productivity. So, in the broadest terms, one thing that should affect investment is your view of productivity. If you think the future is bright, you think the economy is going to expand, you think resources are going to produce a lot of output, then it's a good time to invest. If you think the future looks dim, you think that for some reason the economy is not going to be functioning well in the future, then it's probably not a good time to invest right now. How would that show up here? Well, if the future looks bright, then you might demand more investment. If the future looks dim, you demand less. This discussion that I just gave you might remind you of something that I talked about last week. Well, the week before spring break, which was this perhaps controversial theory of why it is that the business cycle exists at all. Remember, there was this theory that suppose I think the future looks dim, then as discussed, now is not a very good time to invest because it's not going to pay off, right? The expected benefit is low. And if everyone thinks this way and nobody invests, well, then what happens to GDP? Aggregate spending goes down, so the future actually ends up being dim. Or conversely, if we all become optimistic because we think the future is bright, we all invest, and guess what? Since we're all spending more, than the GDP goes higher, and there is this so-called self-fulfilling prophecy based on broad market sentiment. We all become optimistic and it makes the future bright. We all become pessimistic and it makes the future dim. We had a name for that, and that name was animal spirits. This idea that there's some sort of broad market sentiment that itself can move markets, and that fear can lead to bad outcomes or exuberance can lead to good ones. It's controversial, as I mentioned. Not all economists think that animal spirits are a thing, but some do, so it's important that you be aware of this idea. So animal spirits could also be a determinant of investment. Again, just moving the demand curve around. One more thing that could move investment around from the demand side. Remember that investors are a big part of the demand, but they're not all. So that means that the behavior of all the other borrowers who are here on the demand side can affect the investors. What if all the other borrowers suddenly decide that they're going to borrow more for some reason? That would drive up interest rates, but what would that do to the investors? Well, higher interest rates discourage investment. You could imagine that we're in a situation where this demand is only the investors, and then suddenly other people come in and start demanding as well. Then you would end up with a demand curve here where my arm is, and a higher equilibrium interest rate. But this old curve represents the investment. The higher interest rate is doing what to investment? It's making it go down. So I guess what we could put here is other borrowers. In a sense, the other borrowers are kind of competing with these guys. If the other borrowers borrow more, they're pushing up the interest rate, and that lowers how much the investors will get. We'll come back to this in a few minutes. So those are all the things that can affect investment from the demand side. The expected benefits, which we're putting under this broad term productivity, animal spirits maybe, and the behavior of other borrowers. Okay. What next? Next we have things that might affect investment, not because of anything to do with the borrowers, but because of what's going on with the supply side. So to think about this, it'll be useful to think about who is it who's doing the supplying. So a big part of the savings is going to be you and me, the general public, right? We have some of our income that we consume, some of it we set apart for well, to deal with possible risk, or because we are expecting to use it later for some reason, for our pensions, or to buy a house, or who knows what. We have our savings, and so I guess anything that significantly changes your incentives to save might move this curve. What could we give that? What could we call that? I guess, why don't we give it a really broad idea and just call it willingness to save. Why might willingness to save be something that changes? Because we would need it to change in order to shift this one way or the other. I guess maybe it's kind of like the animal spirits, right? If you fear, if you think that tough times are ahead, then you might be, you might want to save more, right? Just because you're afraid of the future, and then that might push this out. But I think the most perhaps important part of this willingness to save idea is the following. Remember that when I was saying, think about who are the savers, I said, well, a big chunk of the savers is the general public. But aside from deciding whether to save or not, you and I also have to make a decision of in what form are we going to hold our savings. So one form in which I could hold my savings is by buying various assets, maybe some bonds, maybe some shares. I could save by putting my money in the bank. Or I could save by buying bonds or shares or using banks in Australia, or in Norway, or in Switzerland. So a big chunk of willingness to save is willingness to save in this financial market as opposed to others. Right? If I decide that I want to save, but I decide that I want to save by buying, I don't know, shares in some company in Japan, that's not showing up here in the saving supply. Or to put it another way, what if I am saving here and then suddenly I change my mind and decide, you know what, I want to buy shares from somewhere else, or put my money in a bank account that's somewhere else. Then the saving supply actually dries up. Interest rates would rise, investment would decline. And again, this would not be due to anything going on with the investors here. It would just be because of something the savers decided. This is related to a term some of you may have heard about what happens in financial markets in places where there's an increase in either economic or political instability, which is this term flight to quality. Have you ever heard about that? The idea is when an economy suddenly suffers either economic or political turbulence, the investors there, or the savers there, I guess to be precise, would say, you know what, I'm not sure if I'm guaranteed a good return here. I'm worried that maybe the instability is going to threaten my wealth, and so I'm going to take my money out and put it in a safer country. Let's say, comparatively speaking, the United States is often the beneficiary of this flight to quality. Then, in the country concerned that's experiencing instability, the savings are all going away because people are afraid of the risk, which means higher interest rates, less investment. the country that's relatively stable, where all the funds are going, well, their savings supply is suddenly increasing because there's an inflow of savings from outside. So they would benefit from lower interest rates and higher investments because we're crossing somewhere here now. So willingness to save in this financial market has two parts, right? It's the domestic savers who are choosing where to put their funds, and it's also the foreign savers who have the choice of putting their funds there or back home or indeed anywhere else. Any questions, comments, thoughts? Another thing that came up in that discussion was this idea that you have multiple ways in which you can choose to save. One that I didn't mention is that you could save by pulling out cash and putting it under your pillow as well, right? If you do that, those savings aren't getting into the financial markets. They're sitting under your pillow. Now, when would you choose to save by sticking money under your pillow rather than putting it in the bank? Sorry?
The banks are unstable.
Right, if you don't trust the banks. Exactly. So that suggests, and actually in addition, even if you save by putting your money in the bank could just hold on to it, right? They don't have to lend. Normally they lend most of their funds, but if the banks suddenly stop lending, which as we've discussed is something that sometimes happens when there's banking instability, well then those funds aren't getting to the demanders. Right? So we can term all of those situations where suddenly the banking system isn't functioning or we aren't trusting the banking system, we'll just call it financial instability. And in a situation of financial instability, well, the savings just aren't making it into this market. Or to the extent that they're making it, the banks are holding on to them and not lending them to anyone. So then you get a decrease in the savings supply. And every now and then in this class, as you may remember, I've talked about financial instability. I've talked about bank runs, which are one example of it. And I don't know to what extent you were thinking of those things as being abstract or far away or of historical relevance only for things like the Great Depression. But now you know. You probably have heard in the news that there have been bank runs in the past week or so. And central banks around the world are trying to deal with this and trying to make sure that there aren't further bank runs and make sure that this doesn't spread. So financial instability is something that's here and now and is always kind of there under the surface, ready to appear. So don't underestimate its potential importance. The Fed, remember, was born as a lender of last resort, and that and various other things the Fed does is key to trying to make sure that financial instability doesn't get out of control. I guess that's another issue. The Fed is also in here, right? Remember we were discussing the Fed's open market operations? When the Fed increases reserves, what does it do? It's putting more funds out there that the banks can then go and lend. So actually, the Fed is in here too. If the Fed increases the monetary base, it's increasing the total amount of reserves. As the banks gradually lend those out, that's also implicitly boosting the savings supply. And what do we get? Lower interest rates and higher investment. Shall I add this to the list? Yeah, why not? Fed open market operations. Now, one last thing on this list. We said it doesn't matter too much. Well, we said that we have to start by thinking, who is it who is supplying savings to this economy? There's a bunch of people who live here. There's a bunch of people who don't. There's the banking system that is playing a key role here in helping supply meet demand. But maybe there are other entities that potentially could save as well. What is the biggest single entity in, I guess, any economy? The government. The government, as we can see here, spends, and the government has income, which is taxes. What if the government is spending less than it's earning? That would be savings too, right? So potentially, the government could be here as part of the saving supply. And if the government's saving behavior changes, then the supply curve could move as well. That said, at least the United States government hasn't been saving since sometime in the 1990s, like before you all were born. So, in practice, at least right now, at least not any time recently, the government hasn't been part of the saving supply. But in principle, it could be. That's good to keep in mind. In reality, of course, the government is spending a lot more than it earns in taxes, which means that it's probably somewhere in the demand. So, we've tiptoed right up to the edge of finishing our discussion of investment and switching to a discussion of government spending. So, why don't we just leap off the edge and deal head on with the question of government spending, which is our third item here. Before doing that, I guess to wrap up this discussion, remember what we're doing is, what we did was we thought about the determinants of investment. We very quickly got to the idea that it should be, that because of the fact that you're trading off future benefits against current costs, and I guess future costs as well, interest rates should be key, which means that investment is determined in financial markets. We're taking a very broad view of financial markets that we call the loanable funds market, and we use it to come up with this list of factors that might change an investment and thus shift the aggregate demand curve. There were some demand side factors, such as productivity, animal spirits, and the impact of other borrowers. And then there are the factors that affect the supply of savings, willingness to save, financial instability, and what the Fed is doing. Okay? And when we did that, we realized, wait a second, the government's lurking in the background here. It's lurking in the background because it could be part of the saving supply if it's saving, which it isn't. But instead, the government is lurking in the background because since it's spending more than it's earning, how can it possibly be paying for the difference? It's one of the other borrowers. So now, let's use that idea to move forward to item 3, government spending. So when we were discussing consumption and investment, our job was to think about the determinants of consumption and investment and then see what that tells us about aggregate demand and aggregate supply. When it comes to government spending, we're going to do something slightly different. We're not going to discuss what are the determinants of government spending. Government spending is determined by a mix of politicians who are in office and government agencies. And our job as economists isn't to think about what their motives might or might not be. Rather, what we're going to do is think about what is the macroeconomic impact of government spending and government spending changes, so that we can use what we know about economics to provide advice to politicians and government agencies, so that whenever they adopt a particular spending policy, they have some idea of what impact it's going to have on the macroeconomy. Okay? And of course, that is not to say that the economic impact of a particular spending policy is the only thing that governments should have in mind when they determine their spending plans. For example, the federal government spent, I think, several $billions towards the development of COVID vaccines a couple of years ago. That policy wasn't there to stimulate the economy. It was there because of a public health need. But again, we can use our knowledge as macroeconomists to analyze what is the economic impact of such a spending policy. So to do that, let's represent the government's budget. So as we were discussing, the government has some spending and it has to obtain the funds necessary for that spending from some source or another, whether it's taxes or whether it's borrowing. So we're going to represent that. But we will have a particular objective in mind. If you look at this equation, it sort of looks like, well, government spending is part of aggregate demand, right? So if I increase government spending, well, I'm increasing aggregate demand, right? Seems logical. But, as we'll see in a second when we take a more careful look at the government budget, whenever the government increases its government spending, it is impossible for the government to do that without changing something else in its budget. And the something else that has to change is going to have an offsetting effect. So it is not that, so even though it looks like a change in government spending, let's say an extra dollar in government spending, well, it's an extra dollar in aggregate demand. It's not going to be. It's going to be less. In fact, some economists argue that it's zero. In other words, an increase in government spending is entirely offset by a change in something else because of the impact that it has on other aspects of the government budget. So let's first represent what it is that the government uses money for. One thing the government uses money for is the government spending, this G here. But there is another kind of, not spending, because government spending means purchases of final goods and services, right? But there's another thing the government does that makes it give out funds, and that is, instead of spending money on final goods and services, sometimes it gives money to people so they can spend money on final goods and services, right? Unemployment insurance, social security payments, food stamps, and so on. And we have a name for those, and they are transfers. So government outlays include government spending and transfers. And how does the government pay for them? Well, one way in which the government could pay for government spending and transfers is by taxing us. Right? But, as we were discussing a few minutes ago, in practice, at least since sometime in the 90s, the amount of funds that the government raises in taxes is not enough to cover the government spending and the transfers. So, this difference is called the deficit, or the budget deficit. It's just the difference between what the government earned in a particular year and its outlays. And the question is, well, if the government has a budget deficit and has since the 1990s, how on earth does it pay for all its bills? And the answer is, well, how would you pay for your bills if you had less income than you spent? And the answer is, of course, you would borrow. I'm going to write new borrowing, because, of course, the government might have some old borrowing that it hasn't paid off yet. So the government has some amounts of debt, as we were discussing. Government bonds are one of the major assets that banks have on their balance sheet. And if the government earns less than it spends, then it's just increased the size of its debt. New borrowing. Okay. So now that we have a picture of the government budget, let's use this to think about what's the impact of a change in government spending. So let's increase government spending. We can see that that's going to raise G in aggregate demand. But notice, if I raise government spending, something else has to change here, right? This new government spending dollars had to come from somewhere. And, well, there are three options, right? So, first, government spending could change without the overall size of this whole package changing. How would that be? Well, what if government spending goes up and it pays for it by just putting out fewer transfers? Well, if there are fewer transfers, what's that going to do? Well, where did transfers come up in our earlier discussion? Transfers came up in our earlier discussion because they were part of disposable income. And if transfers go down, what is that doing to disposable income? Well, it's less. And if disposable income goes down, what else happens? Well, the people have fewer funds with which to buy consumer goods, and so consumption goes down. In other words, if I pay for the extra government spending by lowering transfers, I'm increasing government spending, but indirectly I'm also lowering consumption. So this dollar in government spending isn't leading to an extra dollar in aggregate demand. It's less. So that's the case where I increase government spending, but I don't increase the size of the overall budget because I'm cutting transfers. That ends up lowering consumption because it lowers disposable income. What other possibility is there if I don't want to do that? Well, I could pay for additional government spending and raise taxes to pay for it. Well, where did we talk about taxes before? We talked about taxes before, again, because they affect disposable income. So higher taxes means less disposable income, which again means less consumption. It's the same thing. So your extra dollar in government spending doesn't give you an extra dollar in aggregate demand. There's a third possibility. Bless you. What if I increase government spending and I pay for it by, I don't change the taxes and I don't change the transfers, I just borrow more. So I increase the deficit. Well, what's that going to do? That brings us back over here. Where is the government in this picture? Other borrowers, right? The government is borrowing more. What is that doing? Let's imagine that this demand curve, it represents the demand of everyone except the government. And now let's put in our government, which is suddenly deciding to borrow. That's shifting our demand for loanable funds off to the right. It's raising the equilibrium interest rate. The total amount of loanable funds has gone up, of course, because the higher interest rate is pulling in some savings. But what's happening to the loanable funds that end up with everybody other than the government? It's gone down, right? This is the demand for loanable funds by everyone other than the government. The government comes in, pushes up the interest rate, and takes some of the funds. Everyone else has a higher interest rate, so they don't get as much. So the higher borrowing raises the interest rate, and this lowers, well, it lowers spending of all kinds, any spending that's financed out of borrowing. So it lowers consumption, and probably more importantly, it also lowers investment. Investment is more sensitive to interest rates, so investment is probably going to be the one that moves the most. So again, you try and increase government spending, it doesn't end up having its, so to speak, full impact on aggregate demand because it necessarily reduces spending somewhere else. This effect, where increased government spending raises interest rates and thus suppresses consumption or investment, is called crowding out. Right, so crowding out again is an increase in government spending lowers investment by raising interest rates or consumption. And notice that the same is true for any other thing you might change in the government budget that might try and stimulate the economy. So we looked at the example of government spending. Suppose you try to stimulate the economy by cutting taxes. Well, if taxes go down, you have less to cover this, so the borrowing has to go up. And if borrowing goes up, on the one hand, if taxes go down, disposable income goes up, so you boost consumption, but there's new borrowing, so you're raising interest rates, and you're giving with one hand and you're taking away with the other. And the same thing if you thought you could stimulate the economy with transfers. If you increase transfers, then you're increasing how much you have to borrow. Increasing transfers boosts consumption, but new borrowing suppresses it and investment because of this crowding out effect. So there are several points to underline here. One is that one is the idea of crowding out, I guess, or more broadly that any change in the government budget is going to stimulate on the one hand and slow things down on the other indirectly. And so as a result, it calls into question how effective changes in the government budget, like government spending, are as ways of moving aggregate demand. As a result, arguments about, well, how powerful is this crowding out effect become something that economists end up disagreeing about. Right? If you thought crowding out is not really a thing for some reason, then you might be more likely to support the use of the taxes, government spending, and transfers to try and manage the macroeconomy. But if you think that crowding out is very powerful, then there's no point doing any of those things. So again, economists end up arguing about this. Finally, there's one more effect that some economists argue means that changes in the government budget has no impact whatsoever on aggregate demand. And that is called the Ricardo-Barro effect. Named after two economists. So let's go through this example again and we'll see where the Ricardo-Barro effect comes in. Suppose we increase government spending and we pay for it by increasing new borrowing, which we know has crowding out as an impact. Right? The Ricardo-Barro effect argues that on top of the crowding out, there's an additional thing going on, which is that since this government has now borrowed more, that means that it has to pay off not just its old debt, but it has to pay off this additional debt. Moreover, it has to pay off this additional debt plus interest. And in order to pay off the additional debt plus interest, what will it have to do? Well, sometime in the future, it will either have to increase taxes because they have to pay off this new debt, or cut spending so they can afford to pay this new debt, or cut transfers. In other words, anything stimulating now is a signal that there will be the opposite, a slowing in the future. And that entities seeing this would respond, well, if I know that hard times are coming, what should I do now? I should save to prepare myself for hard times. If I'm saving, what am I doing? Not consuming, not investing. So, according to this effect, then $1 in extra government spending equals $1 lost in consumption or investment, and so the ultimate effect is nothing. Finally, you might say, well, I understand the theory, I understand crowding out, I understand that in theory this Ricardo-Barro effect might be there, but at the end of the day, there's an empirical question. Do we observe that additional dollar in government spending ends up being completely offset by something else? And it turns out that this is not very easy to answer because, again, whenever you're trying to study a particular event, there's so many things going on that it's hard to conclusively say, well, this caused that, or this $1 change here was responsible for 50 cents over there. Right? But, of course, because it's such an important question, there is a lot of work on it. My sense is that, well, partly because it's a very political question, right? Then there's some camps. There's some camps that argue that no, crowding out is not really that powerful. Some that argue that crowding out and so on are powerful. My sense is that an extra dollar in government spending broadly doesn't equal an extra dollar in aggregate demand. It's less. But that there is one time when government spending seems to be much more effective than usual in boosting aggregate demand, which is in times of financial instability. So that's my sense of the literature. Any questions, comments, thoughts about any of this? All right. In that case, if I'm not mistaken, it's a good time for an exit quiz. Let's get going. First question. What ultimately fuels investments? Is it savings, consumption, exports, or government spending? Of course, the answer is savings. Very good. Next. True or false? If you expect productivity to rise, investment should increase. This is supposed to be an easy one. Of course. Next. Suppose you expect productivity to rise. You would expect that interest rates and investment rise, fall. Which one is it? Which combination? Think a bit about this one more carefully. Interest rates fall and investment rises. Is that right? No. Interest rates rise and investment rises. That's right. So everyone got it wrong. Think about the loanable funds market. Suppose foreign entities decide to save by buying US assets. What would you expect investment and interest rates to do? Not so easy today. Right. Because this increases the supply of savings. Next. Suppose the government increases its borrowing. What would you expect in this case? Expect crowding out, interest rates rise and investment falls. And last of all, Suppose there are bank runs. What would you expect this time? And this is a photo of SVP, which experienced a bank run about a week ago. And the answer is interest rates rise and investment falls, because no funds make it to markets. All right, let's see how we did. Nico is third. Thomas is second. And first is Lauren. Great job. Lauren, come up to the front if you want. I have a little something for you. Everyone else, nice to see you. Welcome back. And look forward to seeing you again on Wednesday, if not in office hours. Take care.